Hey everyone, welcome back. I'm Jeremy Saffron. If you're an investor right now, you might be feeling a bit confused, and frankly, you have every right to be. The headlines are telling one story, while the economy seems to be telling you another. Here's the bullish story. The Dow Jones has hit 46,000 for the first time. The S&P 500 is nearing all-time highs, and the consensus on Wall Street is that the Federal Reserve is going to step in and cut interest rates next week. But then there's the other story, the one that feels a lot more real for many people. According to the Department of Labor, weekly jobless claims just saw their biggest jump since 2021. And just this morning, a report from the University of Michigan shows that consumer sentiment has fallen sharply to 55.4. And what's really telling is that consumers' long-run inflation expectations rose again, now up to 3.9%. Now, that leads us to a huge contradiction. If the stock market is so strong, why has a staggering $266 billion poured into the safety of cash over the last 4 weeks? Well, here to help us make sense of these conflicting signals is Ted Oakley, the founder and managing partner of Oxbow Advisors. Ted has over 4 decades of experience advising ultra-high net worth clients. He's also the author of 11 books, including his latest, Second Generation Wealth, which, as someone about to be a dad for the first time, I truly recommend it. Now, when he joined us back in May, his warning about the market risk resonated with hundreds of thousands of you, and so he's back. Ted, great to see you. Pleasure to have you back with us.
Good to see you, Jeremy.
Let's talk about this market. I mean, there's that puzzle, right? The market's cheering, expecting these rate cuts, but the data from the average consumer is showing that they're worried about their finances and expect higher inflation. In your view here, I mean, who has the better read on the real economy right now, the optimistic trader or the worried consumer?
Well, I think it's the consumer. I mean, if you look at even upper middle class income, middle class, lower class income, they are really in a hurt right now. But these people that are in their 40s and 50s have children. They go to the grocery store, anything they buy for education, school, whatever, it's all going up a lot in price. And it has them stymied quite a bit. I've talked to quite a few families like that. And, you know, their problem is that they don't know what to do about it. I mean, they can make ends meet, but it's getting tougher and tougher and tougher. And for the lower side, they're not getting there. And I think that's what basically Wall Street forgets. You know, they're sort of sit in the ivory tower and they forget what happens on Main Street. But I think Main Street is really where you are right now.
Yeah, it's been so interesting to see. I mean, of course, we had McDonald's CEO coming out talking about how even their consumers have changed and that there's a real big divergence here. People are hurting. But Ted, I want to bring up something we hear from our viewers all the time. They'll say, Jeremy, I listened to the bearish warnings and the facts all make sense, but if I'd followed that advice, I would have missed this huge rally. And I mean, they are right? I mean, the market is at an all-time high. But I guess my question is, have the old rules of investing been broken? Do fundamentals even matter in a market so heavily driven by this passive investing, this autopilot buying, and then the expectation of the Fed rate cuts?
Well, I know people get to thinking about that, but a dollar is still a dollar. Mm-hmm. And if you get a dollar, if you buy a dollar for 80 cents, that still makes sense. And if you pay $1.20 for a dollar, that doesn't make sense. That's sort of where you are in the markets today. And I guess where I would disagree with people on the bearish side is you can have a safety net of 35, 40% treasuries or whatever. That doesn't mean you're not participating, okay? Right. It just means you're particular about what you're doing and you're not going to go all in and basically put risk fully on when you know things are at extreme price levels. And I mean really, really extreme. So it's not necessarily, you're not making an absolute 100% call. I'm completely out or I'm completely in. I just think you have to pick and choose and know what you own. And I believe people, that's where they've gotten confused. They felt like they had to be all in the market. I would have missed the market. Well, you wouldn't have. I mean, if you had 2/3 of your money in the market, you wouldn't have missed the market, okay? Mm-hmm. But you would also have given yourself a little sleep at night, because if something goes wrong, you know, you have some liquidity.
Yeah, well said. You know, we got this data out from the EPFR Global. I mean, it's an analytics firm, and they're talking about $26 billion is poured into cash funds in the last month. U.S. stock funds have seen the outflows of about $19 billion. This means retail and institution money is obviously actively pulling out of this rally, even as the indexes hit new highs. I mean, Does that divergence tell you, is the smart money selling to an algorithm-driven rally? What are your thoughts here?
Well, usually at a high, and I've been through a lot of highs, what happens is the late players, and a lot of times individuals, and I have to say individuals get bagged because they keep on buying into it and they can't see what's going on underneath. A lot of the selling that's going on right now, I think, I mean, I know a lot of money managers and good ones. In this past 6 months, 9 months, a number of those have said, we've started to raise some cash now. And these are people that hardly ever have cash, but they're good at what they do. And I think individuals just keep right on going because they say, well, they're not going to let it go down. Fed's going to be there to protect us. And it works till it doesn't. And then you look back and you have to remember what Bob Farrell said years ago. Whatever you go extreme in one direction, you'll usually eventually correct extreme the other way. It may take a number of years, but that's what happens.
If the clients are raising cash, who's doing all the buying at these all-time highs? I mean, aren't your sellers just missing out?
No, I think a lot of people in our industry today have only been around for, say, 15, 16, 17 years. Yeah. They've never really seen what I consider a generational bear market or anything that really hurt them because they were real short term, 4 or 5 weeks down and then come back. And I think those people keep advising people to push that money in. And you have to think about this, though, Jeremy, but with the 401ks, they're automatic. Yeah. Nobody ever comes in and tells you in a 401k, hey, you ought to lighten up here a little bit. That's not what they do. It's a plug and play deal. And so all that goes on like that. It's a sort of an automatic buy. And I think that's where most of the buying comes from.
Yeah, it's funny. I mean, we had that $266 billion that has recently moved into cash. And I guess, the bullish argument is that as soon as the Fed cuts, that cash will be forced back into the market, likely through these 401ks, these passive index funds that buy everything indiscriminately, it seems. Is it possible that this massive flow of money will keep the market elevated for years, regardless of what happens in the real economy?
Well, I don't think so. And I think people have to remember now, I've been through a lot of these where the Fed starts lowering rates and the market goes down. Yeah. Because they wake up one day and say, well, there's a reason they're lowering rates. Things are slowing down. So all these numbers are overpriced. All these profit margins are too high. All that starts to take place. But I mean, I'm not saying you couldn't have it go longer because you can. I mean, when you look at any of the bubbles of the past, and that goes not just our country, but Japan and different places. I mean, they can go on because that money can keep driving in, but you never know how long that goes. My guess is that over the next, 3 years or so, you're going to catch a firm, probably long-term peak in this stuff because the prices are so expensive. Yeah. That you get to a point to where there's no return on what you're buying. And that's really what it amounts to in the long run.
I got to ask you, I mean, I want to shift from sentiment to what people are actually doing with their money. I mean, you talk to a lot of people, Ted, and I mean, according to that recent report from Clearwater Analytics, the treasurers at major companies like Amazon and Uber, well, they're moving their cash out of money market funds and into long-term corporate debt. I mean, it looks like they're trying to lock in higher yields before the Fed obviously cuts rates. But, the last time we spoke, you said you were holding about 50%, a very significant position in cash. Holding that much cash, does it mean that you've missed out on this rally? I mean, for a client paying for performance, what are you thinking about sitting on the sidelines?
Well, Jeremy, it depends on what you own. I mean, I won't get into particulars. I can't do that. But I'd say our performance this year, really look at it this way. This is the way I would explain it. Mm-hmm. If we hold about 45% liquidity across the board now in treasuries. But let's just say the market's up 11 and let's say we're up 8. I'll use that as an example and these are not, but what I'm trying to say is if I'm earning 80% of what the market is earning with only 50% at risk. Mm-hmm. See, that risk reward right there works. that means that you're actually doing really, really well because you're not out there on the full spectrum of risk. And I think that's what people forget to see. On the bond side, we just don't feel like you can ever buy you'll buy long-term bonds and you'll chase these yields in here. It's the wrong thing to do, in our opinion. I mean, we think by this time next year, you're going to be right back to the Fed raising rates, chasing inflation down, trying to push that number. And it looks to us like you're not going to get you'll get a big bang out of this as far as the market. People feel good, but that's the wrong thing to do, is to go out and buy 20 and 30-year paper right now.
Yeah. You've watched a lot of these Fed cycles. I mean, with what's happening right now, there's the politicization, obviously, but there is a little bit of accuracy on some of the data. It's worse than was previously thought. I mean, have you seen anything like it? Well, what's your thoughts? Are they going to go and hit 50 next week?
Well, even if they do, and I'll just use these numbers, you're at 4.5% on the Fed funds. Let's say you go to 4, and prime rate goes to 7. I mean, if I'm a business out here and I own part of a bank, so I know if I'm loaning as a bank and I was at 7.5 prime and now I'm 7, am I really going to get that much more demand for borrowing based on a 0.5 point? I don't think so. I think that number is still such that you won't get a big bang of it. People will think it'll make them feel good, but the only thing it's really going to do is drop the rate that they're earning on the short-term treasuries or CDs. That's where it's going to really affect them.
Yeah, it's so wild. I mean, obviously the audience wants to know how to apply this to their own portfolios. I mean, in our last interview, you gave us some really good specific names, really. I mean, you mentioned fertilizer companies like Nutrien Pharma, like AbbVie, New Miner, New Gold, I think you mentioned. I mean, that stock's up over 100% since we last chatted. I mean, it was one of the most popular parts of our conversations. And I want to kind of ask you, I mean, if an investor has new cash to deploy today, what's that one company, that sector that you believe offers a compelling combination of that value that you're talking about, but the safety in these uncertain markets too?
Well, if you'll give it 1 to 3 years, so to us, it's the most undervalued probably is energy. Wow. For 2 or 3 reasons. One, their free cash flow is really high. I mean, I'm talking about after capital expenditures, debt, everything, your free cash flow left over in all of these companies ranges anywhere from 8 to 11 or 12%, which is really, and then if you look at the dividends, all the energy that we own and have bought, if you look at the yields on those, they range anywhere from 5 all the way up to 9 or 9.5. So you're getting paid a lot to wait in energies at 63, oil at 63. And I've mentioned this before, maybe it goes to 45 if the economy keeps on weakening. It could. So what you do is you don't buy full positions, but you own enough of it to where if you get a breakdown back and they get a lot cheaper than that, you can add to those. But if you look out 15, 18 months, 2 years, there's a chance oil could be back at a new high, 150. It came from 130 in 3 years to 62. And it wouldn't surprise us again 3 years from now to have oil at 150 or so. But you got to wait on it, and you can't get all hung up on well, I'm not beating NVIDIA, because these are truly good buys. In other words, they're paying you to own it. They're also cheap from any kind of vantage point you want to look. And oil companies, what happens with them, when they move, they really move. They'll get with it. And they haven't done a lot. I mean, they've gone up some, don't get me wrong, but they could drift a little in here if the economy weakens, severely. But that's just part of owning those. But that's probably the cheapest sector, in my opinion, anyway. We own a lot of different things, but that's one of the cheapest.
Is this, Ted? I mean, is it kind of the picks and shovels to the AI boom? I guess we need a lot more energy. Are you looking at things like natural gas, nuclear, anything like that, or is it mostly these oil and gas giants that have kind of been beat up?
Jeremy, no, we own a lot of natural gas, a lot. We own 3 or 4 natural gas pipelines, which pay tremendous cash flows. I'm talking about 7.5% or higher, 8%. that pays on a K-1, so you don't pay any current income tax on them. But in addition, we own up and down the spectrum. You'll see where we own the big name like a Chevron, like a Northern Oil and Gas. You'll see us own that kind of company. We're really up and down the spectrum. Now, I will tell you, we don't own any of the drillers. They can move and they can do well, but that's not where we're concentrated. And we don't own a lot of the offshore drillers either. So we're really primarily in the producers, natural gas, and the midstream too.
Yeah. I mean, I know you can't speak about those returns, but you're a very successful money manager yourself. I mean, Ted, let's make this kind of practical for our viewers. When you look at a company today, knowing that this broad market is ignoring traditional valuations, what are the top or 3 specific metrics that you kind of focus on to decide if a business is good investment? I mean, can you walk us through your process a little bit? I think people have forgotten it.
Well, for us, there's 4 or 5 things, but one, I'll just start with a balance sheet. You want to make sure debt to equity is okay, because if a company is heavily laden in debt, then you have to be perfect on the buy or where they are in the cycle. So that's really important, that debt to equity. The second thing that you look at is you really do look hard at free cash flow and what these can, and for all your viewers out there in free cash flow, it's really what's left over after you've paid everything else, plus what you've had to reinvest capital expenditure wise to build new plant and equipment, et cetera. But you look at that because that's what gives them the ability to increase dividends, to buy back stock, pay down debt. No, that's all good stuff right there that you look at. And we try to go out about 5 years and estimate what we think these companies can earn. And then we discount it back with a sort of an inflation number that we'll put on it. Right now, it's about 3%. And then we'll try to buy it a little better than that. And we're just trying to buy it. We try to give ourselves as much buffer as we can against being wrong. You need to realize what you have to do in money management is make sure that you don't lose a lot of money. Because that's where it's hard to catch up. And I always recommend that to people. Remember risk management. It's the most important thing.
Yeah, take a little bit of profit from time to time. I've been through that myself. I got to ask you, I mean, we got to move on to the metals. But before we do that, I reviewed the tape, our last interview. As I said, it did really, really well. And some of those names that you were buying at the time are very defensive names, like the Abbey V, the drug maker, food company Unilever. With the consumer now showing signs of weakness, are those defensive sectors still kind of a top focus outside of those energy picks that you just talked about?
Well, we still own them, but I'll give you an example. Things we've been buying recently, and these are not, these are opening positions, which means that they're smaller, so you add to them over time. But if you look at Crown Corporation, which just basically makes cans that you drink out of, that sort of thing, Otis Elevator. I know these are mundane sounding companies, but you use them every day, believe me. In what you do, we just added Gildan activewear, and for all you moms and dads out there, just go look in the back of that T-shirt, and probably half of them will say Gildan.
No kidding.
You look at things like that because what are they going to do? They ain't going to buy during bad times. They're not going to go down and buy a lot of Ralph Lauren for their kids, but they're going to buy some T-shirts, and things like that. It's things like, it's a different group of stocks we found that are doing well, but it's interesting. When they hit a cash flow number for us and hit the right numbers, like Regeneron, which is probably one of the best biotechs that's out there. And Regeneron really came off a lot. And when it got cheap enough, and I'm talking about down quite a bit, we took a position, Regeneron. We've owned that stock in the past and done well with it, and very, very well-run company, I will tell you. And then, we have lightened up on some things and too, but generally we're still probably across the board in all 3 strategies, about 45% in treasuries.
Interesting. Okay, 45 still in T-bills. I want to bring back, because you talked about, some of those companies. You weren't buying Lululemon, right? I mean, you're not sitting there buying the expensive brands. You're talking about brands that would be on the average American. I mean, is that kind of the play here? Is that economy that we're talking about, those Main Street struggles, they're going to kind of be the drivers of this economy?
Well, for example, Lululemon, we don't own that stock and haven't. But if you look at, the last few months after they announced and everything, and you could tell that their buyers, were obviously backing off. And, and they're sort of some ways you get in one of those companies like that, that's like a one product, the stretch pants for women. That's a big product for them. And all of a sudden they get competition. But I think right now you have to buy, if you can get them cheap, you have to buy the mundane companies, pay you good cash flow, pay you good dividend. And people have to remember too, Jeremy, on a dividend, I'm getting, say on a dividend, you can buy the corporate bonds all the time, but you're going to pay ordinary income tax on that. But on a dividend, I'm only going to pay 20%. So it has its advantages, and the treasuries have their advantage. You don't pay state tax with those. So there's a lot of things fit together and all of that, but that's how we're structured right now.
Yeah, makes sense. I mean, you got to think about those tax jurisdictions too. I want to pivot to another asset class that's been telling a very different story from the S&P 500. I mean, I'm talking about precious metals, which have had a truly historic week. I mean, gold just flew past its 1980 inflation-adjusted peak, hitting an all-time high of 36.74 in the futures this week. You told me in May that you hold a lot of physical bullion. I mean, and you also said all the way through as a core currency hedge. I mean, is this record run the ultimate kind of indication of that long-term thesis? And where do you see it going from here, Ted?
Well, what I said then is what I always say is that we have three strategies, but in the conservative fixed income strategy, almost everything we own in there, we own is less than 60-month maturity, okay? And if you're going to own that as a currency hedge, because we feel like long-term, the dollar will continue to decline. If you're going to own the fixed income, you have you've got to own some bullion, some gold bullion to offset it. And that's what will offset it. And it's a different time now. I know people want to think about it, but most of these major countries are lining up against us, not for us. Look at Russia, China, India, to an extent, some of the South American countries. And they're buying gold. They're not turning their dollars around and trying to buy back into the assets of this country, particularly treasuries. They want to own something. Like even a lot of them against their own currencies are doing that. So I think you have to own it as a hedge like that. We're in a different era, a different time when probably a lot of currencies. Look at the sterling, pound sterling. You look at the euro, yen. You can't have faith in a lot of these, including the dollar. And I think that's why more of them side by side, they own the gold bullion. And that's what I think people have to keep in mind.
Yeah. And they haven't stopped buying it either, even at these record prices. You were talking about cash flow before, getting back to those basics and bringing up cash flow. I mean, the miners, some of these miners are printing cash. Are you looking at the miners right now? Do you think that there's still room to go? I mean, a lot of them have had some great upside, but still early?
Well, we own a number of miners. Now, in our stock account, we only own the royalty companies like Franco-Nevada, Royal Gold, Wheaton. But in a high income account, which is sort of a commodity offset account, pays a lot of cash flow, we own the direct miners. I mean, we own Agnico and, like I mentioned before, a little company, New Gold. But we have also in there, we own Royal Gold, Wheaton. But I think people have to remember, and I think this will bother them probably, but if you get a correction in gold, and let's just say you went down to 33,000 or 3,100, I think people would think it's over and it's done or whatever. It's probably not, because of the way the world's set up this next decade. Especially, we feel like commodities and inflation are coming back. That's going to be a new world order. And if that's the case, you don't want to get shaken out on a downturn like that, because you could very well get it. But for new money, yeah, we still buy them. We may not buy quite as high a position as we would have a year ago or a year and a half ago, but we still own the same ones. Yes.
So a little bit of panic hands. I mean, we've seen that in that cyclical industry, right? There seems to be a pullback. Everyone kind of reacts. Is it a time then, I guess what you're saying is to buy the dip if that happens? I mean, how much, do you think it's too euphoric here? Do you think gold needs to come down a little bit, take a breather?
I don't know. I think it confused a lot of people, Jeremy, when it went through 34 or 3,500. Yeah. They thought that was it. And you can't ever tell till afterwards, but it really didn't. It kind of drifted sideways for quite a while. Mm-hmm. But there's just a lot of reasons why, with all of the turmoil that's in the world, I think that gold will become more owned. See, people like, it's not a very highly owned asset. You look at the miners, virtually nobody owns them. Yeah. I mean, they're, you're looking at gold and gold miners. They've been one of the best groups, maybe the best group this year. But yet you're not going to hear it on Bloomberg or CNBC. Yeah. I hear it from you, but
good. Keep listening.
Else.
It's wild, huh? That just a little bit of volume, a little bit of buying in this market can trigger, a 50% uptake on some of these equity sides because there's just no liquidity there.
Yeah. They're very profitable, though. If you go in and look at today's numbers, I'll just give you this example. And I used this graph in a presentation last week. I said, let's just take the GDX, which is the large gold miners, okay? Mm-hmm. We have just now equaled the price of the GDX as to what it was in 2011. That's 14 years ago. I mean, we're just now even. We're not breaking in the new highs yet, and you're not even close on the junior miners.
Yeah, no kidding.
And so while they've had a move, they have to realize how cheap they were. And if you look at the cash flow numbers now on gold miners, if you were to sell those same multiples of that cash flow as you had in 2011, those stocks will double or triple from here.
Mm-hmm. Mm-hmm. Do you think that there's still some value? I mean, I know that it takes a lot more due diligence to look at the juniors, but I mean, has it been kind of some of these major caps, Nikko, for instance? I mean, yeah, they're printing capital, but their stocks are up. Who's got more of an opportunity to run?
Well, they probably do. You have to be good at that area, though.
Yeah.
And I think people that do well in the junior miners, that's what they do. That's not what we do. And we're not good enough to do that. So if you're not good enough, then you don't need to be in there, because there's a lot of things going. I think there'll be a lot of merger acquisition in that area, though, and probably do some really good. I mean, and then we own silver bullion too, and we own Pan American Silver. But see, it will really outstrip gold someday. I mean, usually when it starts moving.
This is good, Chit. I mean, it's almost like you're reading my notes here, because we haven't talked about silver, but it's been on an absolute tear. I mean, it's hit a 14-year high of nearly $43 an ounce. How are you looking at silver right now? Do you see it as a better value, like you just said, having more upside than not just the bullion, but I guess the miners too here?
Yeah. Well, we only own one miner. We own Pan American, because but it's, again, it fits what we do. On the bullion, we own it. We don't own as much as we own in gold, because it's more volatile. Mm-hmm. And it's not as, I don't know how to explain it, but to us, it's not as stable as gold is. But when it really moves, it moves much faster and stronger than gold does. But we own them together, really, in particular in a high income portfolio, and that's how that's structured together. But yeah, I think you can own a little bit of silver too.
Yeah, well said. We just had Ross Beatty on, Pan American founder. I mean, how close do you follow the management teams? Is that kind of, I mean, you've seen and been through a lot in this miner market. Are you kind of looking towards those teams as opposed to maybe the asset itself?
Well, I wish we could bring Pierre Lassonde back to run some company.
Amen.
For all of those who don't know, he was a founder of Franco-Nevada, really bright man. Mm-hmm. But no, I have quite a few contacts in the business, and that's how I check them. That's how I check a lot of the management people, because that's sort of a business unto itself.
Yeah. Yeah.
You have to know what's happening. So what we do is we stay in contact with a lot of people that know those people, and they can tell you, hey, this is bad management here. They got a good asset, but bad management, or reverse. Good management, they can turn that asset around and see what happens.
Yeah, no, well said. Okay, this has been an incredible move in precious metals, in this rally, but it really speaks to the deep desire for wealth preservation, which is kind of the central theme of your book, Second Generation Wealth. I mean, that part of our last conversation really stuck a chord with the audience, so I want to spend a few minutes there. Let's start with the basics. I mean, for a young person watching today who feels like they're behind, which a lot of them do, with little or no wealth to even speak of. I mean, what's the single most important first step maybe, that they can take to start, building this future?
Well, I tell a lot of young people this, and I don't think as many of them are listening, but you have to get out of debt. Yeah. Okay. If you are debt laden, you're never going to get ahead. I mean, you have to figure out some way to really save more than you're spending. And have some left over. And I think a lot of young people right now are just living for the moment. They're living for the experience, this, that, and the other. But that doesn't do them any good for the long run. If I sit down with them and say, hey, if you'll put X amount of money aside, let me show you what that would do. And then and use a nominal number, 6-7%. And it'll surprise them at how much money they would have. But they have to get out of debt first, and they haven't been afraid of debt. And I think that's the first thing they have to do.
Yeah, well, everyone gets free money, right? At 22%.
Well, I think too, what I say in the book is more about parenting, and if you have a lot of wealth, don't bestow that on your children. Let those kids have to go out and earn it the hard way, and then they'll appreciate money. I always say you can't appreciate money if you've never experienced having the lack of money. Like if I show up and I'm, which I don't agree with this, but a lot of financial people, financial planners and stuff, they want to bring them in at 16, 17, 18 years old and say, look, here's how we manage the family wealth, blah, 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 blah. Well, you just took all their ambition away from them. Yeah. You don't really want them to know that right now. I disagree with that concept.
Yeah. I mean, I remember reading that in the book. I mean, your advice is not to talk to children about a large inheritance until they're in their 30s. As you mentioned, that ambition for those. I mean, expand on that. I mean, if you're not talking about the numbers, what should parents be teaching their kids about money in their teens and 20s to prepare them properly?
Well, number one, you want to live by example. So if you're sloppy as a parent with how you spend money, and I think it comes into play more than anything else. We work with a lot, and over the years, we've done this since 1983, worked with business owners that have sold companies. And that's where the problem is, because their one lifestyle was pretty frugal, and they're working in the company, and all of a sudden, boom, they've got $50 or $100 million. Yeah, and they start spending and doing sort of crazy things with the money, and the kids see that and they think, guys, we're ultra wealthy, and so I don't have to do anything either. I think example is number one. Number two, though, I think nobody understands the quality of work. Yeah. If you can require your kids to go out and work for 6, 7, 8, 9 years, whatever, and then if you want to try to bring them back to the business or the family office, and that's one thing, but you need to wait till they've hit the wall a few times and gain some experience, because that's what gives them self-esteem. That's what you want for your kid anyway. You want self-esteem. You want them to be able to stand on their own 2 feet. And I always say, make them stand up. So if you didn't have any money, they'd still do okay. Yeah. But I think a lot of parents, though, come in a lot of money, and they take the easy way out, which is just give them everything they want.
Work ethic, huh? Accountability. Imagine that. All right, that's great advice. Let's get to the other side of the spectrum. For those who have built their nest egg, right? I mean, you've given that stark warning in May about retirees kind of being dangerously high in equities. I mean, with the stock market even higher today, what's your direct advice to the person watching who's looking at their portfolio balance and they're feeling euphoric? I mean, maybe even a little invincible.
Well, I know they don't think about anything could go wrong. And it's interesting, if you look at them, there's a lot of accounts that we can have somebody come to us, example, and they've got, $5-10 million account, and they're older. What I mean, they're 75 or 80 or higher, but they have a lot of that portfolio in stocks, and they want to stay that way, okay? Now, we won't take those kind of accounts, and the reason we won't is because from a fiduciary standpoint, that's not the prudent thing to do, because that person is not at that stage to where, numerous things could go wrong. I mean, health, a lot of things can happen. And they're not at a point where, and I always ask people, particularly if you're over 60, okay, if whatever, you name the reason, 40% of that portfolio is gone tomorrow morning, how would you feel about that? In other words, really hit that between the ears there. How would you feel about not having that money? Most of them, I think, it would really, really bother them. I think it would not only be economically tough, but I think it'd be socially tough for a lot of them. And I say this over and over again. It would be socially tough and economically tough for their kids, because if they lose a lot of money, guess who's going to take care of mom and dad? And I think people have grown so accustomed to the Federal Reserve and fiscal policy of just saving everybody that they think, really, it's no big deal. I've made so much money, I'm not worried about it. But believe me, when they lose money, they worry about it. But I always come back to this: what can happen to my portfolio, and I'll continue to sleep good every night, get up next morning, feel great, whatever. What's that number? Okay. And it's different for different people. I know it is. But as you get older, you don't have a lot of choices. Okay. Not only choices in terms of earning back wealth, because most people over 70 have all the wealth they're going to have as far as, what they have. It can be a lot of money. Don't get me wrong. But it's what they have. And so then you got to start thinking about preservation.
What's the line between investing and gambling?
Well, investing is buying in a productive asset.
Yeah.
I mean, pure and simple. If I buy, and that can be a lot of things now. I know it can. I love real estate. It could be real estate. It could be oil and gas. It could be private companies. It could be a lot of things. But it's a productive asset that produces profits, produces cash flow, produces returns. To me, speculating is just what that sounds like it is. It's putting $1 on the line and hoping the next person comes along and will pay you $2. Now,
well said.
To me, that's not investing.
Yeah, invaluable advice for families everywhere, Ted. Appreciate it. Hey, before I let you go, let's wrap up with a few quick forecasts on the market. First, the S&P 500. I mean, where does it close out in 2025?
Oh, I have no idea, Jimmy.
No correction, maybe this year. It feels like it's going to.
One of the things I always say is don't predict price and don't predict time. But I will say this to answer your question. I'm not trying to. If you look at it, it won't be surprising anywhere in here that at a minimum you get a 10 or 15% sell off just as a situation where something goes wrong, or these numbers keep coming in weaker and weaker, and people say, you got to remember now, these portfolio managers, when you get down into October, November, if they've got really decent numbers, they're going to put some lockdown on it because they know they've made their year already.
Yeah.
And so that's part of it too. But I wouldn't be surprised if we don't get kind of a short, it's kind of what I call a sobering up sell-off. Maybe not the end sell-off where you really have a big move down. I think that comes eventually, and it may come from a different, maybe it comes from 7,000 or something on the S&P.
Yeah.
But things gets expensive and they stay that way for a while, and then something changes that changes the whole situation, and then all of a sudden you go into what I call sort of more of a generational bear market kind of thing.
Yeah.
I don't think you're there on the internet right now, obviously, but you have to remember people in this industry, our industry, there's a lot of them that have never been through inflation.
Yeah, no kidding.
I've had to manage through inflation. That's a different game, all right? And they've never had to manage through, downturns. You go on and on and on, and they really hurt, and you just can't get ahead on them. Those are things they've never experienced, and so I feel like that's coming some point in time, and you're going to be able to see who knows how to weather that storm.
Yeah, well said. Experience key. I mean, history does repeat itself. And I mean, on the price of gold, 6 months from now, I mean, is it going to be higher or lower than it is today? I know we don't have a crystal ball, but I mean, are we going to get that pullback? What do you think?
Well, if you get a sell-off in the market, Jeremy, gold and gold miners are going to sell off too.
Yeah.
But I would tell you, it'd be like '08. They sold off in '08. By the time we got to the end of '09, they were a new high. And we started, and then they really soared all the way up to 2011. And so, they'll sell off. They're not immune. When the market sells off strong, the only thing that's not immune is the 90-day Treasury, in our opinion.
Yeah.
Okay. And people try to hedge it and do this, that, and the other, all sorts of things. But if you really, anything that's up is going to get sold. So they'll sell them. But I think if you looked out a couple of years from now, 2 or 3 years from now, gold will be higher, silver will be higher, miners will be higher, even if you had a correction.
Yeah, I was going to ask you, I mean, that was my last one. Do you think, silver is going to finally break that iconic 50 mark this next year,
Wouldn't be surprised as you go through 26, yeah.
Yeah, let's zoom out here. Last question to you. Appreciate your time again. I mean, when we think about all we've talked about today, Ted, I mean, what's the single biggest risk to the market right now that you believe is completely mispriced? I mean, looking into 2026, what do you believe is the biggest financial surprise, the one event or trend that no one's kind of talking about today?
Well, geopolitically, I think is a big one. I think this idea that the U.S. is so strong that we can throw our weight around on China, Russia, India, all these other countries, and we're not that strong to do that. And it's that geopolitically, that is one. Okay. Secondly, is that when you get into this tariff situation where countries are hitting against each other, that's what happened. During the Smoot-Hawley and all of that, you had countries that were vying against each other. And what happens when is that you have all sorts of things get out of line, and there could be some blowups there. And then the second thing is that companies just are not as profitable. People don't realize this. The estimates for the S&P for 2026 are up 16% on profit. We don't think there's any way they can hit that number. And I think all of those things will be surprises in one way or another that could hurt you. But again, if the companies get cheap enough, we would buy them anyway, but they're not there right now.
Yeah, well said. All right, powerful forecast to end on. Appreciate this. Ted Oakley, founder of Oxbow Advisors, author of The Second Generation Wealth. Thanks for your time, sharing your wisdom today. Appreciate this.
All right, Jeremy.
All right, have a great one. Appreciate it.
Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.